Good evening, friends. Myself, C.A. Nitish Chugh. Today, we are discussing the provisions of income computation and disclosure standard. The background is yesterday I was speaking at a seminar organized by Trinagar Keshapuram Study Circle, and we were discussing the ICDS clause wise or standard wise ICDS. And then Gupta ji, R.K. Gupta ji, a very senior chartered accountant and my mentor also, he came up with an idea, why don't we shoot a video for the same so as to circulate it amongst the masses, since there are various differences that are there as per the accounting standard and the ICDS. So today, being the last day before the code of conduct for regional council election is coming into picture, so I'm trying to prepare a short video on various differences that is there as per the accounting standards for corporate as well as non-corporate assessees and income computation and disclosure standard. So starting with the background of the ICDS, ICDS came into picture in 2015, applicable for assessment year since 2016-17, but their usage or their practical application is on a very lower side. Most of the members, they do not fill the columns that is there in the tax audit report, clause number 13D, E or F of tax audit report 3CD. So we are discussing today the standard wise differences between the accounting standard and ICDS. Starting with the first standard, that is relating to ICDS 1 on accounting policies. The major difference in this is relating to M2M losses, mark to market losses. In case there is any mark to mark losses relating to any currency swap, interest rate swap, or any other derivative other than the forward contract, the accounting standard says that it has to be, the losses has to be accounted for in the books of accounts as M2M losses, but ICDS says that nothing to be accounted for in the books of accounts. So this is M2M losses relating to other than speculative business. If any entity, any corporate has taken any call or put option and hedged their foreign currency exposure, then mark to market losses as at the year end has to be accounted for in the books of account as per the provisions of accounting standard 1 read with accounting standard 11. But ICDS says that no losses to be accounted for and resulting into increase in the profit for the purpose of computing income under the ICDS. The first point is basically ICDS is applicable for all the assessees who are using the accrual basis of accounting for determining income under the head PGBP, profit and gains from business or profession, and income from other sources. Right, so it is not applicable for those assessees who are using the cash basis of accounting. So first point of difference is relating to M2M losses. Then moving on to the next standard, that is relating to ICDS 2 on valuation of inventories. Under the under this standard ICDS 2, there is prohibition of using the standard costing method. If any SSC is using standard costing method for valuation of inventories, then they have to change the same and value the inventories either by using FIFO or weighted average. Additionally, specific identification method is also permitted under the ICDS. So this could also lead to either increase or decrease in the profit depending upon the calculation that has been worked out for valuing the inventories. Then moving on to the next standard, ICDS 3 relating to construction contracts. It is applicable to all the contractors who are into the construction. It is also applicable to real estate operators, BOT operators. The criteria is they permit only the percentage of completion method. So accounting standard 7 allows percentage of completion method as well as the total service completion method to recognize the revenue in the books of accounts, but ICDS does not permit the total service completion method. They only allow percentage of completion method. Plus there is one more change in this standard. If the construction contract has not completed the stage of 25%, then revenue can be deferred if it is not being reasonably certain. Then in those scenarios, if this percentage of completion is less than 25%, then revenue can be deferred under the ICDS 3. Additionally, one more change in ICDS 3, one more difference in ICDS 3 is relating to expected losses. So, Accounting Standard 7 says that expected losses from the contract has to be recognized in the year when there has been a change in the estimate. There has been a change in the estimate of the total cost, and it is reasonably certain that the entity will incur losses in that particular assignment or particular contract. But ICDS says nothing doing like this. Only actual costs incurred till date will be allowed. No provision or no expected losses will be allowed as per ICDS 3. We also read this standard with ICDS 10, ICDS 11. Now, moving on to the next standard, that is ICDS 4. ICDS 4 is relating to revenue recognition. Revenue recognition is similar to our accounting standard 9. The interest in the royalty payments are accounted based on the time payments or based upon the service agreements by the assessees. Revenue is recognized on the transfer of all the uh, transfer of ownership right to the buyer. But there is one difference in this case also. This also allows percentage of completion method in case of service contracts. But in case there is, service contract is less than 90 days, service contract, if it is less than 90 days, then revenue can be deferred and can be recognized by using the total completion method. However, as per AS 9, you can recognize revenue based upon either the percentage of completion method or total service completion method. This is the only bifurcation. If total service completion method is allowed under ICDS only if the contract period is less than 90 days. So, assuming a contract that has been entered into by an SSC on 1st of February and the contract period is 75 days, as on 31st March, revenue needs to be recognized. Revenue has to be recognized if the entity is using percentage of completion method under the AS7, but it can be deferred by ICDS 4, right? So this is another point of difference. Moving on to the next standard, that is relating to ICDS 5. ICDS 5 is relating to tangible assets. So what are the differences in this? Accounting standard 10 and Ind AS 16, they allows the discounting of the deferral payment terms as per the contract. If the contract period is more than 12 months for payment of the liability for acquisition of a property, plant and equipment, then in that case the same has to be fair valued and the difference has to be accounted for as an interest income or expense. In our case, since it is a acquisition of PPE, it is interest expense. Someone selling the property, someone selling the equipment, it will be recognized as an interest income as in the previous standard. But ICDS says nothing like this. We do not accept this criteria of fair valuation. Whatever has been agreed between the buyer and the seller, the same will be recognized as an asset. The same value, the same measurement will be applicable for the recognition of asset, and the asset will be capitalized by the amount agreed between the buyer and the seller. So discounting is not permitted under the ICDS. This is another point of difference. So we have discussed till now various points of differences between accounting standard and ICDS. The first one was relating to M2M losses. The second one was relating to valuation of inventories for in which the specific identification method was allowed and standard costing was not allowed. In ICDS 3, we have discussed the criteria of 25%. If the contract stage of completion is less than 25%, revenue can be deferred if it is not reasonably certain, and expected losses are not allowed. Then in ICDS 4, we have discussed the criteria of service contract which is less than 90 days, the revenue can be deferred. In ICDS 5, we have discussed the discounting of payment if it is more than 12 months, right? Moving on to the next standard, that is relating to foreign currency exchange fluctuation, ICDS 6. There is another standard, there is accounting standard 11 in comparison to this, which says that both the standard says that monetary items should be translated at the year end at the closing rate, and any exchange difference has to be accounted for as an income or expense of the year. But there is an exception under the ICDS, read with section 43A of the Income Tax Act. Section 43A is very, very important. It says that it starts with a non-obstante clause, notwithstanding anything contained in any other provisions of the Act. If there is any change in the liability or borrowing used for acquisition of an asset, overseas asset, it talks about the overseas asset. If the asset has been acquired from outside India by using the borrowed funds or by the buyer's credit or any other liability, and there is an exchange fluctuation at the time of settlement or at the year end, then what will happen to the exchange fluctuation? The exchange fluctuation will be capitalized under the Income Tax Act on actual payment basis. For example, if I say on 1st of January, the company, the entity has acquired an asset from China, right? The cost of acquisition was $100. As on 31st March, as on the acquisition, the dollar rate was 80, but as on 31st March, the dollar rate has moved to $82. So there is an exchange fluctuation of 2 rupees per dollar, that is 200 rupees, the exchange fluctuation. Now, as per the accounting standard, the same has to be accounted for in the books of accounts as income or expenditure for the period, since it is short term in nature. But as per account ICDS or read with section 43A, it will not be allowed as an expenditure or income, since it is relating to a asset which has been acquired from overseas outside India. What will happen? This will be reversed, and at the time of actual payment, for example, extending this example, in the month of April, the payment has been made at the rate of 85 rupees per dollar. So the differential of 5 rupees, $100 into 82 and $100 into 85, 80 and 85, sorry, 5 rupees into 100, 500 rupees is the total exchange fluctuation that will be capitalized in under the Income Tax Act to the cost of the asset. If the asset has already been capitalized in the previous year, then it will be added to the block of assets. So this is the major difference. We generally ignore the provision of section 43A, which is very, very important. I request all the members to carefully go through this, because we have assessees who acquire assets or import assets, and there is exchange fluctuation at the time of settlement or at the time of restatement of asset or liability, right? Then this is all about section ICDS 6. Then moving on to the next standard, that is relating to ICDS 8 on valuation of securities, that is securities. So there is a major difference in the accounting standard and ICDS 8. The difference is relating to valuation of listed securities held as stock in trade. What happens is accounting standard says to value the same as per the cost or NRV, whichever is lower. That is agreed. ICDS also says to value the same as per the cost or NRV, whichever is lower, but on a category basis. Accounting standard says you value it as per script wise or category wise, you have to disclose it. But under ICDS, category wise valuation is only permissible, script wise is not permissible. So this could lead to increase in the profit for determining income under this standard. I have also given a detailed example for this in the PPT. PPT will be attached in the description. You can go through the same. The entire discussion that we are doing today, that is there in the PPT. There are other examples also. There are examples, illustrations, and other uh, differences also. I am just discussing the major points which are affecting most of the SSCs. Then moving on to the next standard, that is relating to borrowing cost. So borrowing cost, there is a major difference. In case of specific borrowing, the entire amount after the borrowing has been considered is capitalized under ICDS. There is no deferment or there is no restriction in case the work is held up. Whereas accounting standard 16 says that if there is other than temporary held up or the work has stopped on the qualifying asset, then the borrowing cost cannot be capitalized even if it is for a specific project or there is a specific borrowing. If the project is not running ongoing, then the interest cost cannot be capitalized as per AS 16. But there is no such restriction under the ICDS. It has to be capitalized once the borrowing has been taken. The interest cost, whatever is the entity is incurring, it has to be capitalized only. There is no other method to charge it to revenue. Further, in case there is temporary investment of the funds borrowed for the project, specific borrowing has been temporarily parked for investments and there is interest income or any other income on the same, then the accounting standard says to reduce the same from the borrowing cost eligible for capitalization, right? But in case of ICDS, it says nothing like this. It has to be offered to tax under the head income from other sources. It will not be reduced from the borrowing cost. This is also a major point of difference which we are not being doing it. We are not doing justice to this provision. So this what I am saying is based on the limited interaction I had with the members over the past few days while conducting the tax audit, while interacting with them on the tax audit aspects. So this is also one of the difference, borrowing costs relating to specific borrowings, and then there is one difference relating to borrowing for general purposes, interest that is being capitalized on qualifying asset based on the general borrowings. What happens, the criteria is different, the capitalization method is different. There is a formula, specific formula that is being defined under the ICDS 9, which says that interest incurred on general borrowing multiplied by the average cost of the qualifying asset divided by the total cost of assets, excluding those assets which have been specifically funded. There are specific borrowings. The amount that is there can be capitalized to the fixed assets. However, the capitalization criteria is different in case of accounting standard 16. I have given example, a detailed example for this in the PPT. You can go through the same, and if there is any doubt, anything relating to that, you can come back to me on either WhatsApp or you can mail the same to if there is any query. Then moving on to the next standard, that is relating to provision. What happens is the provisions on probability is allowed as per accounting standard 29. We have to make provisions on probability basis, but that is not permissible in ICDS. ICDS says provision has to be made on reasonable certainty. If there is any reasonable certainty, then only the provision can be made, not on the probability basis. Like we have discussed in ICDS 3, that expected losses is not allowed under ICDS. Expected losses in relation to construction contract is not allowed. It is read with this standard only, that provisions for uh, based on probability is not allowed. Provisions on reasonable certainty is allowed. So these are the differences. Let me recap all the differences. ICDS versus accounting standard. The first one is relating to M2M. The second one is relating to valuation of inventories. Specific identification method is allowed. Standard costing method is not allowed. The third one is relating to construction contracts. The 25% stage of completion is not there. Then contract revenue can be deferred if it is not certainable with reasonable certainty. Also, expected losses are not allowed. Then, related to revenue contracts, percentage of completion method is allowed, but if the contract period is less than 90 days, then total service completion method is also permissible under the ICDS. Moving on to the next standard relating to tangible fixed assets or PPE, property, plant, and equipment versus this fixed assets. The deferment of the payment resulting into time value of money or interest cost is not permissible. So this is in general. The time value of money is not considered under ICDS. It could be in borrowing cost. It could be in relating to valuation of inventories. It could be in relation to the property, plant, and equipment. It is not permissible. Then moving on to the next standard, that is relating to exchange fluctuation. Exchange fluctuation, we have already discussed that 43A, in case of assets imported from outside India, if there is any exchange fluctuation, then whether it is related to any liability, borrowed funds, or buyer's credit, or any creditor also, it has to be capitalized on the actual basis. Then ICDS 8 is relating to valuation of securities held as stock in trade. In dash gate, category wise valuation is required, script wise is not permissible, leading into increase in profits. Then borrowing costs we have discussed in detail, and provisions we have also discussed in detail. Thank you. This is the end of the video, but I'll also share the PPT along with the description of this video. If you have any other query or any other area for which you want me to elaborate, you can please ping to me. I'll definitely try to make the video. Thank you. Thank you.